Okay, so those separately stated items that I alluded to. So we've got the ordinary income, that's just, whatever essentially our net income from operations is what's gonna be included in our ordinary income. For separately stated items, these are all those items, and they could be income items, they could be expense items, they could be deductions, they could be credits as well. Certain credits are separately stated for each of the partners. That all of those items that could be treated differently at the partner level, we've got to pull those out and report them separately so that the partners can report them correctly on their own individual tax return. Most common separately stated items, or I guess that was the list that we just looked at. So like I said before, that Schedule K lists the partner's share in total, the partner's share of income, credits, and deductions. The K is for all the partners. Schedule K1 is individual per partner, but it's gonna be add up all the K1s, it's gonna total what's on Schedule K, okay? So each partner in a partnership must receive a K1, which reports their share, the partner's share of ordinary income or loss, and each separately stated item. Section J of the K1 shows the partner's percentage share of profit, loss, and ownership. So that's going to be based on the partnership agreement. Let's see. Yeah, the line items on the K1 correspond directly to the line items on the Schedule K, which is part of the 1065. Summation of all the K1s, whether there are 2 or 5,000 partners or more than that, would equal the total on Schedule K. So the allocation to the partner is the year-end percentage of their ownership multiplied by the total amount of each item on Schedule K. So if a partner owns 20% of a partnership and the ordinary income line on the Schedule K is $100,000, on their K1 it's going to say $20,000. They're 20%. And the same thing for each of those lines. They're going to get 20% of each of those lines on the Schedule K. If there's a change in ownership during the year, though, there could be a special allocation that has to be done. Okay, that creates some complications. So this is what a K1 looks like. So you can see here ordinary income, all of that on just one box there, that box 1. Rental real estate income, other rental income, guaranteed payments. So this particular partner, Lulang Wu, so here's the partner's name, the partnership up here, whether they're a general partner or a limited partner. If they're a limited partner, they're just an investor, that income would not be subject to self-employment tax because they're just an investor, okay? So that's an important piece of information, general partner or limited partner. Ending percentage, so this partner owns 40%. So they got 40% of all the income and separately stated items that were on that Schedule K on the Form 1065. This is like their share of the liabilities. Don't worry about this. You're not going to be asked to do anything there. This is the partner's capital account. So this is going to start with their beginning capital account, which is something the partnership will keep track of. They're going to add any cash that was contributed. It's not always the basis, but oftentimes it's the basis. But it can have other things involved in it as well. If they contributed more to the partnership, that would be added in there. The income that they're having to pay tax on from the partnership is added. That increases their basis. Withdrawals. So if they took out a distribution, that decreases their basis, and then their ending capital account there, which, like I said, it's not always the same as basis, but it can be pretty close. So we can see the separately, so this partner received guaranteed payments of $42,000. That means that the ordinary business income was reduced by that $42,000, but all of that was then, it's plucked out of the ordinary income and plopped on the K1 for this particular partner, who now has to pay tax on all of that 42,000. There was obviously some dividends, they're qualified dividends that the partnership received. This is their percentage of it, so that's gonna go on their Form 1040 on page 1. Short-term capital gains, long-term capital gains, if this was a negative, they'd be losses. That's gonna combine with the other, maybe they've got short-term capital losses and now they can combine it with this income and zero it out, you know, on their own individual tax return. 1231 gain or loss there. Other income, this is what is other income? 2,600. I'm not sure what that is. They don't tell us. I can't remember exactly. Actually, I think that's supposed to be the section 179, if I remember right. So ideally, what should happen, this amount here, current year income or loss, 64,755, we should be able to arrive at that number using this here. So but maybe not. Let's see, 64,755. Oh, okay, so self-employment earnings. We should be able to get there, but I don't see how we get there. $64,450. Okay, so they're not including they're not including the 42,000 in there because we're going to pay tax on it. So it's not going to be included in this. So the 64,755 should be 64,450. Let's see if we can get there. Plus 1,100. Plus 1,000. I think this should be minus, plus 115. What are we at now?
62,665.
And then they've got the 2,600. I don't know what that other income is. I don't know where they got that. 64,755. I may have missed something there. But really that should be like our current year net income or loss. Do I have another deduction somewhere? I don't see it. Self-employment earnings should be, it was 91,940. It's 102. Where the heck are they getting these numbers? I don't know where they got those numbers. Because that really should be like the ordinary income plus guaranteed payments minus any section 179, but it's not that. Anyway, I'm not gonna try and waste any more time figuring that out. But you can see, so we've got like collectibles, gains, unrecaptured 1250. Remember that? Unrecaptured 1250. Look, it's come back to haunt you. 1231. Like I said, I'm not quite sure what the 2,600 is. I don't know what code A is off the top of my head. Section 179, so that would be separate. Again, self-employment earnings, credits. So if there are any credits that they get a distributive share of the credits, those would be like maybe work opportunity credit, tax credit, that kind of thing. Or if there were any energy efficiency credits, that sort of thing. And then distribution. So this individual received $26,000 from the partnership. That's going to reduce their basis. In the partnership, that's why it's also included over there. All right, so what happens when ownership percentage changes during the year. So we've got Knox, owned a third from January 1st to March 31st. And then he bought Smith's third as well. So then he owned 2/3 for the rest of the year. They had $76,000 of ordinary income, $8,000 in long-term capital gains, barring any special allocations. There might be some special allocations, like in the partnership agreement, they may have some other arrangements with regard to the percentages. This is how we would calculate the share of income. So 76,000, he would get a third of that, 76,000 for the first 3 months of the year, 2/3 of it for the remainder of the year. Same thing for the capital gain, a third of it for the first 30 of the year, 2/3 for the remainder of the year. So capital gain that's allocated to him is there, 4667. So that's where like I said, the ownership percentage changes during the year. Because as much as accountants would love to have every transaction happen on December 31st at the very end of the day, it doesn't always work that way. Self-employment income, I already talked about this. So if they're a general partner, they have self-employment income on that ordinary income. If they receive guaranteed payments, there's self-employment income on that guaranteed payment, just as though they were a Schedule C. Oh, they didn't put this is what's missing. There is supposed to be 179 expense, but it's just not on there. See that? 10,600, but it's not. There's nothing there. That's why I can't, my math ain't mathin'. Qualified business income deduction still qualifies for the qualified business income deduction, just like a Schedule C would. Same calculation, right? So 20%, but we've got all those. You've got to compare it with 20% of taxable income as well, whichever is less of those. All right.